This right here is a graph of the NASDAQ Composite. Think of it as a giant scoreboard that shows how well a group of more than 3,000 companies, mostly in technology and biotech, are doing in the stock market. You don't need to be an economist or have a PhD to see that this could be the biggest bubble we have ever seen. And the crash that follows will be the biggest in history. Looking back at the last market bubble, what was once considered a significant peak now appears almost laughable in the shadow of the astronomical heights the NASDAQ Composite has reached today. Even if you were the world's worst investor and you put all your money into the index at its peak, you would still be up around 246%. Yet this pales in comparison to the staggering 1,300% climb from its September 2002 lows. Such exponential growth goes beyond mere market optimism. It flirts dangerously with the realm of the absurd, prompting a chilling reflection on the bubble we may very well be inflating right now. This isn't just growth, it's an unprecedented explosion in valuations that far outstrips the fundamental underpinnings of the companies it represents. The magnitude of this increase echoes the most extreme moments of previous financial bubbles, but with numbers that far exceed those earlier highs. This suggests we're not merely observing a bubble, we're on the verge of a potential financial disaster. The alarm bells should be ringing loud and clear. This kind of runaway growth often precedes a sharp and painful correction. History teaches us that what goes up with such breakneck speed can come crashing down just as fast, leaving devastation in its wake. Investors, inflated by a mix of innovation hype and speculative frenzy, may find themselves in a precarious position if this bubble bursts. To compound the issue, today's market growth is largely fueled by a small group of stocks. In fact, market concentration is at an all-time high. A chart that's been making rounds on Twitter, created by Kenneth R. Fretch, illustrates this point vividly. It compares the top 10% of stocks by size to the entire US market, offering a clear picture of market concentration. The findings are concerning. Currently, the top 10% of stocks account for nearly 75% of the market's total value. This level of concentration hasn't been seen since the Great Depression in 1931, marking today's stock market as the most concentrated in nearly a century. For context, during the dot-com bubble of 2001, the top 10% of stocks peaked at around 72% market concentration. Before the 2008 financial crises, this figure was around 66%. On average, the top 10% of stocks typically represent 64% of the entire market. Clearly, we're not in typical territory. We're significantly above what's considered normal, even surpassing levels seen just before the Great Depression. This raises a critical question. Are we on the cusp of a massive market crash? This scenario presents a stark reminder of the risks associated with such high levels of concentration. When so much of the market's value is tied up in just a few stocks, it leaves the entire system vulnerable to sudden shifts in those stocks' fortunes. The term Magnificent Seven is gaining traction today, referring to a powerhouse group of tech giants: Microsoft, Apple, Nvidia, Amazon, Alphabet, Tesla, and Meta. The combined market value of these 7 companies is so vast, if they were their own stock market, they would rank as the second largest in the world. These companies are at the forefront of the market's impressive performance this year, capturing the attention of investors worldwide. However, it's worth noting a curious trend. Corporate insiders within these companies have been selling their shares despite the remarkable returns their stocks have generated. This activity raises eyebrows, especially when considering the extraordinary gains these companies have achieved. A chart by financial analyst Charlie Bolello highlights the significant disparity in performance. Since the beginning of last year, the S&P 500 index, which represents a broad spectrum of the US stock market, has seen a healthy increase of 32% in market value. In stark contrast, the Magnificent Seven has outpaced the broader market with a staggering 92% return. This divergence highlights the outsized influence these tech behemoths exert on the overall market performance. Their success stories have been a major driving force behind the year's market gains, but the insider selling phenomenon introduces a layer of complexity. It prompts questions about the sustainability of these high returns and whether they reflect underlying economic realities or are merely the result of speculative fever. The stark difference in performance between the broader market and these select few companies further highlights the concentration risk within today's stock market. It illustrates how the fortunes of a handful of companies can overshadow the broader economic landscape, making the market increasingly sensitive to their trajectories. No matter how it goes for the 7, the market moves in cycles. The tech-heavy NASDAQ was red all 4 quarters for the first time ever in 2022, but now it's riding all-time highs. Zooming out shows you the important question: how high can the magnificent 7 climb? You have to ask yourself, are parts of my portfolio set up to survive if it all falls down? Because chances are we won't see another Nvidia, Amazon, or Apple. But you don't even need to if you diversify a portion of your investment with high-value, low-correlation assets like fine art. UBS found almost 4 out of 10 collectors worth over $30 million invest nearly 30% of their wealth into art like this. But it's not just billionaire corporate executives diversifying with legendary art offerings anymore, because you can do it without investing millions and from the comfort of your own home. Thanks to our sponsors at Masterworks, investing in general has inherent risk, but each of Masterworks' 21 exits thus far have delivered positive returns to investors. They've been pulling in median net returns like 14.6, 16.4, and 17.6% on works held longer than a year, and even more. It's no surprise that over 900,000 people have signed up. Shares from more popular offerings have sometimes sold out within minutes, but my subscribers can skip the waitlist and start investing today using the special affiliate link in the description. Now, even if we look at someone like Buffett, you can get the same feeling from his actions. We all know Buffett popularized something called the Buffett indicator, famously saying that it was probably the best single measure of where valuations stand at any given moment. And what the Buffett indicator is pretty simple. It's really a financial metric used to gauge the valuation of the stock market relative to the size of the economy. It's calculated by dividing the total market cap of publicly traded stocks in a country by the country's GDP. Essentially, it compares the price of buying all the stocks to the total value of goods and services produced by the economy. When the ratio is high, it suggests that the stock market is overvalued compared to the economic output, indicating that the stock market might be expensive. This scenario is often interpreted as the market being too hot, suggesting caution for investors as it may signal a bubble or overenthusiastic investment behavior. Conversely, a low ratio implies that the market is undervalued relative to the GDP, indicating that stocks might be cheap and potentially a good buying opportunity as the market could be considered too cold. Essentially, it's a way of taking the market's temperature to understand whether it's overheated, undervalued, or reasonably priced. Right now, the indicator is creeping up once again, going from this portion right here labeled overvalued territory to strongly overvalued, which is more than 2 standard deviations away from normal. And even if you don't believe this model, you can always take a look at Warren's recent decision making to understand how he truly feels about this wild market. Consider this: if Warren Buffett saw genuine bargains in the market, it's unlikely he would allow Berkshire Hathaway's cash reserves to swell to a record-breaking $168 billion. A closer look at the latest SEC filings reveals that the Oracle of Omaha has strategically reduced stakes in 3 long-standing investments during the 4th quarter: Apple, HP, and Paramount Global. Notably, he brought down his Apple holdings by nearly 10 million shares, equating to a reduction of almost $2 billion. Equally significant was his decision to nearly exit his investment in D.R. Horton, a move that caught many off guard. Buffett's investment in the home builder last year was a surprise to many who deemed the market overvalued and on the brink of collapse. Despite Warren Buffett's reputation for a long-term investment approach, he didn't maintain his position in D.R. Horton for long, likely securing substantial profits upon exit. Apart from increasing his stakes in the energy sector and substantially boosting his investment in SiriusXM, Buffett refrained from exploring new ventures. This pattern of selling, coupled with targeted buying in oil stocks and the strategic withdrawal from the housing construction sector, raises question about his outlook on the market's short-term prospects. The decision to sit on a cash pile of $168 billion suggests a cautious stance, possibly indicating skepticism about the market's immediate future. Buffett's actions hint at a belief that the market may not offer the kind of value he seeks, reinforcing the notion that he might be bracing for less favorable conditions ahead. And we'll get into this in a different video, but if you really want to take a look at the centerpiece of this bubble talk, it's Nvidia. This is a stock that since October 14th, 2022 has risen by over 660%. Looking at a chart, you can see how it's essentially been going straight up. The company is now the 3rd largest in the world by market cap, only behind Microsoft and Apple, and with the way its earnings report went last time, there are many who believe it will continue to soar from here. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know what you think about the market in the comments below.